The field of economics is often called the dismal science, and the depressing state of today's environment certainly helps us understand why. Inflation is running amok, interest rates are rising sharply, stock and bond markets are both down considerably, and we may already be in a recession. I'm Chris Sabul, and I'm here with Mark Armbruster to discuss what could be a protracted bear market, paving a tough road ahead for investors.
It's true, we're not terribly optimistic at this point. But for a less somber outlook, check out the companion video called The Bull Market Case to get a more balanced view of the investment markets today. We have included a link in the video description.
Let's start with the Federal Reserve. All eyes are on the Fed as they raise interest rates in an attempt to curb inflation. So far, they have raised short-term interest rates from close to 0% less than a year ago to over 3% today, with promises to go even further in the near future. The Fed adjusts interest rates mainly in reaction to expected inflation, raising rates when inflation is hot and lowering rates when inflation cools. Many economists believe the Fed is behind the eight ball as inflation rages, and some even blame them for causing our current predicament.
Right. The most basic definition of inflation is often summed up as too much money chasing too few goods. And if you think this through, there are two ways inflation can spiral out of control. Either too much money in circulation, which causes excessive demand, or supply constraints that weighs on the availability of goods. Today's inflation has excessive liquidity and reduced supply. To confront excess liquidity, the Fed can raise interest rates and engage in what they call open market operations, like quantitative tightening. Both are going on now, and the Fed is pledged to continue until inflation is under control. The problem is that the Fed can't really do anything about supply constraints. In fact, it may even make matters worse. By raising interest rates, the Fed will likely slow economic growth, perhaps even to the point of a nasty recession. And if growth slows, corporate profits generally take a hit. Unemployment then rises, and fewer resources are available to produce goods and provide services, which further reduces supply. Ironically, reduced supply could result in even higher inflation if demand remains robust.
The other problem is that the Federal Reserve is not the only actor in this drama. While monetary policy is important, fiscal policy, or government spending, also plays a big role.
Fiscal policy certainly has had a hand in the current situation. Excessive expansionary fiscal policy is likely the main driver of the recent inflation surge. And unfortunately, while monetary policy is restrictive, the current fiscal policy is undermining the Fed's fight against inflation.
Yes, there are a number of examples to that. The CHIPS Act will result in $39 billion of new spending. The recently passed Inflation Reduction Act authorizes $391 billion in new spending, only somewhat offset by new revenue streams. In addition, President Biden's executive action forgiving student loans could, by some measures, unleash an additional $400 billion or more into the economy.
There may be justifiable social reasons for these initiatives, but the increased liquidity will, at least to some degree, offset the Fed's efforts to curb inflation.
Federal, local, and international government policies are also weighing on supply. Despite elevated oil and gas prices, there have been very few new permits for energy production this year. This is an issue in the U.S., but even more acute in Europe, where Russian energy has been cut off. In addition, despite record high home prices, environmental restrictions make it hard to build new homes in many parts of the country.
And restrictions on farmers have led to unrest in Sri Lanka, the Netherlands, and Canada, all resulting in reduced food production and higher food costs, despite wheat trading near the highest levels in over 50 years.
Some believe the solution to these issues is to transition away from fossil fuels, which may solve some of the problems, but it could create others. For example, electricity is already in short supply in some markets. Suppose everyone starts driving electric cars, using electric lawnmowers, and moving aggressively away from petroleum-based products. It is unlikely there will be enough lithium and other raw materials to meet demand. It is also possible only limited permits will be issued in much of the developed world to produce more of these minerals.
Unfortunately, these factors create supply shortages that steer us towards a situation where inflation may persist despite the Fed's best efforts. And those efforts will almost certainly slow the economy, so a stagflationary period with low economic growth and high inflation, reminiscent of the 1970s, cannot be ruled out.
All of this means that we'll likely have greater volatility for both stocks and bonds. The stock market hates uncertainty, and there is plenty of that, both now and likely in the future.
History shows us that stocks do okay during periods of high inflation, as asset prices can also rise. But slow economic growth is not conducive to stock market gains.
Bonds could rally from here, despite the Fed raising short-term interest rates, but for all the wrong reasons, like if we have a painful recession or financial crisis that causes investors to flock to safe investments like high-quality bonds.
Yeah, otherwise rates could continue to rise for some time.
We should point out that we may be wrong in our assessment, and the Fed will engineer a soft landing. Still, the optimistic scenario seems unlikely. So preparing for a new era with ups and downs across all asset classes and the potential for further stock declines is best. Thank you for joining us, and be sure to check out the link in the description below to our vidcast on the bull market case for a more favorable market outlook.